Hey there, Brad Castor from GreatOptionTradingStrategies.com. Let's talk about LEAPS. So in recent months, we've begun officially trading LEAPS inside the Leverage Investing Club. Unofficially, we've been trading them for years, and I actually have a video course inside the club covering the ins and outs of LEAPS, calendar/diagonal spreads. Now, real quick, the Leverage Investing Club is my private option trading membership site that I've been running since 2012. It's not the easiest thing to join, and I'm not going to try to sell you on it here, but if anything in today's video resonates with you, and you think you might want to work with me at some point and be part of a really great long-term trading community, and for a one-time, easily recoupable investment for lifetime membership, be sure you're subscribed to my daily options, tips, and insights newsletter. I only offer membership to readers of the newsletter and only occasionally, as in once, maybe twice a calendar year. There's a link to the Great Option Trading Strategies downloadable library page in the description below. Download one or more of the free ebooks, special reports, or strategy guides, and you'll begin receiving the newsletter automatically. Or you can simply sign up directly via the pinned comment below. Okay. Back to LEAPS. Now, I'm very selective in making these official club trades. To date, since the end of May 2025, and at the time of this video, it's the end of August 2025, so basically 3 months, we've only traded 2 of them. But we're 2 for 2, and both have been nicely profitable. We bought and sold Pepsi January 2027, 110 long calls, and that resulted in a 14.5% total ROI over 34 days. Or 155.66% annualized. And we also bought and sold Fiserv June 2026 $120 long calls that resulted in a 14.78% total ROI in just 6 days, or a ridiculously skewed 899.01% annualized. So what are LEAPS? LEAPS stand for Long-Term Equity Anticipation Securities. That's a very formal name for something pretty simple. They're basically options that don't expire for a year or 2 or more. They also have 2 potential advantages. Number 1, they can be used to generate leveraged income. Think of this approach as covered calls on steroids. By buying call options that don't expire for a year or 2, you can effectively control X number of shares, 100 per contract, for a fraction of the cost of buying the underlying stock outright. And then, as with standard covered calls, you can then write or sell near-dated call options against the LEAPS. If, for example, I can control a $120 stock for, say, $30 a contract, the ROI for my selling near-dated calls against the LEAPS is going to be much, much higher compared to what I can generate with a traditional covered call. This approach goes by different names: calendar spreads, time spreads, horizontal spreads/diagonal spreads, depending on where the strike prices are set, and poor man's covered call, or PMCC for short, because of the substantially reduced capital requirements. Now, I've always hated that last name because guess what? Poor people don't trade them, or if they do, probably not very well. A more suitable name, in my view, would be the sophisticated man's covered call, because they aren't as simple as they appear, or as simple and straightforward as regular covered calls, and there are some potential pitfalls you have to navigate. But leverage income isn't the only way to go with LEAPS. They can also be used to generate leveraged capital gains. Same rationale here. If you can control a stock for a fraction of what it would cost to buy the stock, and then that stock trades higher, your long call LEAPS will appreciate at a meaningfully higher rate versus the shares of the stock. But as with the sophisticated man's covered call, it's not quite that simple, and there are other factors and potential pitfalls to consider. Now, here's a really good question. Why not do both? Why not get both leveraged income and leveraged appreciation? Unfortunately, it's not that simple. You basically can't. That's because the more you structure the trade for leveraged income, the more you limit your potential capital appreciation. And the more you structure the trade for leveraged gains, the more you have to sacrifice the income potential. Looked at from another angle, you can build downside protection into the trade by focusing on income, or you can build upside protection by focusing on capital appreciation. Or you can try splitting the difference and build in smaller amounts of protection to both the upside and the downside. As you might imagine then, trading LEAPS is, at least in my view, lucrative but maddening. LEAPS-based trades have such potential for really great outsized gains, and there's also a lot of flexibility in terms of repairing one if it goes the wrong way on you. And hey, any trade that can be repaired if it doesn't go according to plan is going to get my attention. But they can be so frustrating to trade as well. That's because you won't know until afterwards how you should have structured the trade, for income or for gains. Now here's a perfect example. It's the chart and final returns on a Coca-Cola Leap spread personal trade I did on the stock way back in 2015. I definitely can't complain as I made 15.93% total returns in 26 days when Coca-Cola made a nice 9.26% move higher. I set and managed this trade to be income oriented. But if I'd done nothing but simply buy and hold the leaps, meaning no short calls written against the leaps, which ended up very much being a drag on the trade when the stock moved higher, my final returns in the form of capital gains would have been 50.99% in just 26 days. Of course, I also would have had no downside protection built into the trade, but, which in this case, I obviously didn't need. So you see, lucrative but maddening. I've actually experimented extensively with different income approaches when it comes to leaps. I developed customizable strategies, shared all these with the Leveraged Investing Club community, and of course, gave them all really cool names like the perpetual income strategy, the first down strategy, the long fuse strategy, maximum income 2.0, maximum income 3.0, and even maximum income 3.1. Again, these have always been personal trades and campaigns, not official Leveraged Investing Club trades, but I have chronicled and documented a ton of these trades inside the club for educational purposes. Just to be clear, the club isn't a blindly follow me service. A big emphasis is on skill development, members exploring their own strategies, and a lot of comparing notes. So my takeaways from trading a lot of leaps, calendar/diagonal spreads for leveraged income, 2 of them. Number 1, despite a lot of success on the income front, a lot more money invariably gets left on the table in terms of missed capital gains. And number 2, to be truly successful in terms of maximizing your income potential on these income-oriented leaps trades requires a lot of activity. Case in point, in my personal account, I'm currently running a leaps calendar or diagonal spread campaign on Palo Alto networks that ideally I'll continue for many years to come. But I'm extremely tactical and active with my short option trades. In the first 5 to 6 months of the campaign, I've already had more than 110 separate short option trades or legs. Seriously. Obviously, that's not appropriate for official club trades where I send out real-time alerts. It would be a lot to expect club members to keep up with everything, and I'd probably break my keyboard and or my fingers trying to send them all out. So let's look at something simpler, but that can still get you lucrative, outsized gains. Buy and hold leaps. What we are doing inside the Leveraged Investing Club is going back to our value investing roots and being very, very, very selective. So I look for beaten down, high quality stocks where I have a strong conviction that the stock in question will be trading materially higher in the next year or two. And then we buy deep in the money long call leaps and ideally just sit on our hands, as in we don't sell any near dated calls against the leaps, which for me as a dyed in the wool option seller can be really hard. Of course, we do have the flexibility to sell calls against the leaps at some point if the trade isn't going according to plan and begin repairing/recouping that way if necessary. But so far, we haven't had to do that. It also helps after you've identified a situation where you have a strong conviction that the stock in question will be trading materially higher in the next year or two, just to be patient and wait for attractive technical setups when timing your entry. And I would argue we did just that with both the Pepsi and the Fiserv trades. Now, these trades can really move the needle on your portfolio. As I mentioned earlier, to date, since the end of May, we've successfully traded 2 of those. The Pepsi January 110 long calls for the 14.5% ROI over 34 days, and the Fiserv June 2026 120 long calls for 14.78% in just 6 days. Now, I know what you're thinking. By closing these trades out so quickly, I'm still leaving lots of money on the table. It's true. But here's the deal. If I'm trading these as official club trades, you can be sure I'm going to err on the side of being conservative. With Pepsi, I saw that we could exit the trade with nearly 15% returns in a little more than a month. And this was important while avoiding the upcoming earnings release. So that was a super easy decision. And it's not like I'm holding a gun to the head of any club member. Again, the Leveraged Investing Club is not a blindly follow me service. It's a here's what I'm doing and why, and you make your own informed choices type of service. And then with the Fiserv trade, a leaps trade that went all of 6 days, I was originally targeting a possible exit at around the $143 resistance level, which would have given us, I estimate, 25 to 30% total returns. But as you can see in the chart here, the stock ran into trouble around the 140 level, so I decided to lock in gains of, again, nearly 15%, since I could do so in less than a week. Now, at the time I'm recording this, the stock is still trading below $138 a share, so in the short term, I feel the move was validated. Although longer term, I do believe the stock will be trading materially higher in the coming weeks and months and years. Now, this is important. You don't have to be this conservative. While I officially exited the Fiserv trade after just 6 days, in my personal account, I have a larger version of the trade still open. I do really like the stock at these levels, believe the bottom is in, although I've been spectacularly wrong before, and I expect shares to steadily trade higher off this new lower base over the next few years. So personally, I'm holding on to my leaps and hope to benefit from leveraged capital gains on a larger scale if I'm right. I'm also much more active and tactical in my personal account when it comes to incorporating near-dated short options against the leaps to further reduce my cost basis or generate income from the position, depending on how you choose to view those short option trades. I actually see my Fiserv campaign as a sort of leveraged synthetic investment, if that makes sense. And while I continue to document these personal trades for educational purposes inside the club, in the Daily Tips newsletter, and here on the YouTube channel, it's much more than I can realistically provide to club members in real time. We have some very active traders inside the club, and we have some who are much more casual. The point is, the more active and engaged you are, the more you can do with these trades yourself. And the opportunities are out there. Maybe not every day, but they do routinely pop up throughout the year. Now, personally, I'm not comfortable buying and holding long call leaps on richly valued growth stocks. As I mentioned earlier, I do have a Palo Alto Networks leaps campaign going, but that's very much income focused, and I'm trading and adjusting a lot of short options against those leaps. But as far as simply buy and hold, because there's potentially so much downside on richly valued growth stocks when there's a hiccup, I think a buy and hold approach there is just playing with fire. Although that would have been a very winning approach over, say, the last 2.5 years. But even in a fully valued or overvalued market, value investing opportunities where going with a buy and hold leaps trade can be appropriate do still emerge, like the Pepsi and Fiserv trades we looked at today. Or T. Rowe Price. This is one where I made 31.84% gains in 116 days, or a 100.20% annualized ROI. This was in my personal account. It was mostly buy and hold, but there was some limited option, short option premium income as well. About 90% of the returns came from capital gains and 10% came from income. Now, this trade predated us beginning to officially trade leaps inside the club, but I love T. Rowe anytime it slips below $95 a share. And had we officially started in on leaps earlier, I definitely would have made this a club trade. And over the last year, there were similar opportunities with Starbucks, Nike, Disney, and United Health. In fairness, from a buy and hold perspective, and repair later with short options if needed, I truly recognize the opportunities with Nike and United Health. But I would have missed the opportunities with Starbucks and Disney because I wanted to see those stocks trade even lower before being enticed. Similar situation with Lulu. Some big name investors have swooped in, and they very well might be right, and the bottom might be in. But at this point, I don't see the stock trading at a level that I find compelling enough where I'd want to go all in with a leaps buy and hold trade. So the point is, there's always going to be an element of subjectivity involved, but at the end of the day, Mr. Market is typically going to drop the ball and give you a few to several really good opportunities a year to get some really nice leverage gains at his expense. And we should definitely take advantage of him anytime we can. Okay, we've covered quite a bit today. Now, while I focus a lot on straight income trades, as in cash secured puts and covered calls for income, those aren't the only smart and savvy ways to build hedge you win, tells Mr. Market loses into a portfolio. Leaps-based trades can also be very flexible and forgiving. Okay, I would love to hear your feedback, questions, etc. If there's some other part of this process you'd like me to cover, please let me know in the comments below. And if you enjoyed this and want more, be sure to check out the channel's other videos. I'm actively adding new content again and have a backlog of video ideas I want to share with you. I'm also organizing these videos in various playlist categories to make it easier for you to find the resources that are the most valuable to you. Also, sign up for the Daily Tips newsletter via the pinned comment below. Options are the ultimate high-yield income vehicle, and wealth-building vehicle for that matter, and they can be structured in so many different ways to generate sustainable and safe high-yield income. The Daily Tips newsletter is a perfect complement to this channel because I can cover more topics and sometimes deeper in written form versus video form. Again, you can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there and you'll automatically begin receiving the Daily Tips newsletter. Heads we win, tails Mr. Market loses. That means you should be coming out ahead on virtually all of your trades. Okay, until next time.